do a little bit of a chart on the correlation between natural gas and DBC. There's a couple things I want to talk about on natural gas. Obviously, we added to our UNG pretty much at the lows around 636. We did get a small bounce, but natural gas got absolutely slaughtered today. I think we're very close to seeing a low. I know we've been saying that for a little bit, but this pattern is still technically intact. I mean, you still were able to hold that weekly candle. Obviously, nat gas isn't closed. There's still 1 day left in the pattern, so anything can change. But you had a beautiful sell-off. You're still holding this weekly reversal. Even on the larger term time frame, you still have that monthly bottoming tail. And I still think people are just getting liquidated, because if you factor in that people are if anyone who chased the natural gas trade, and there was a hell of a lot of traders that chased the natural gas trade. But basically what I'm observing here is, if anybody who tried saying the trend is our friend, natural gas is broken out, they were correct. Natural gas did break out over here and had a beautiful move to the upside. But if you chased this move and piled in here, which a lot of people did, right at this candle high, which is why we've gapped down and bled lower ever since. So many people piled in here, and look how much they're down underwater. 31%. And most of those players play the double and triple levered ETFs. Imagine playing double boil, down 64%. Imagine a triple. Oh my goodness, you would be screaming from the top of the hills like, what did I do? You'd basically be getting liquidated. So I still remain bullish on natural gas. One thing, obviously, I did do a comparison in the chart of last night was the DBC ETF, which I'll actually throw up on this live broadcast right now. But the DBC ETF and natural gas are completely oversold. I mean, the divergence is clear. Basically, on this DBC ETF, you can see that the pre-COVID high was around here, January 29th, when you had your big dip in the stock market. Your COVID crash was down here. The DBC is trading well off of its pre-COVID high, basically 33% away from the pre-COVID high. And then you take a look at natural gas. Natural gas, basically, COVID bottom was around here. The pre-COVID high was around November here. Then we came into December, started collapsing, and then the COVID crash was around here in March, give or take. But natural gas has retraced and pierced its pre-COVID high. It's done a full round trip. I would argue natural gas has already crashed, and we're seeing in the making a basing formation occur. You are getting positive divergences on the RSI, on a couple other indicators as well. If people look at that, I don't really pay attention to that, but in times of extreme oversold or overbought conditions, I will look at that just to make sure that it's backing up my overall thesis and technical picture. But needless to say, DBC hasn't retraced. Natural gas has done a retrace. Typically, natural gas and DBC do trade in lockstep, but natural gas often has a tendency to lead. You can see that DBC put in a top here around June 7th, and this is the commodity basket ETF. Has like gold, silver, sugar, a whole. I'm not going to name all a few. You can look it up online. Just type in DBC ETF and you can see the composure of this ETF. But it has all the necessary commodities that we track. And basically the divergence is clear to me. DBC topped here in June. Nat gas did a top, but it actually made another double top. So natural gas made another brand new high when DBC already fell and collapsed. Now natural gas has collapsed already to the lows, and you're seeing DBC rally. So there's a negative divergence in the ETF, and typically these do correlate to a high degree. It's very rare to see natural gas break this divergence to a degree of such a high margin when natural gas is trading well below its pre-COVID high, and this is trading well above its pre-COVID high. So I think we're going to see that catch up. And another thing I want to compare to is, obviously I did have one of the members ask that couldn't natural gas go lower in a stock market crash? I'm not getting any signals yet of a crash. There obviously are, the conditions do favor a crash more than ever in my opinion. There are systemic risks that could cause massive down limit days, but the bond market hasn't really given us that definitive signal of a crash yet. Obviously it could happen, over a 1 week span. Things could change very drastically, or even in 1 day. But right now, that's not my base case. Obviously, if a crash was to occur, one thing I want you to pay attention to is, this chart's a little bit messy. So I'm just going to remove this chart right now, remove all the drawings, and we're going to overlap the S&P, the SPX, in a new pane, okay? So the SPX, and let me just take away this volume over here so it cleans up the chart. But basically the SPX, I want to go back to a couple different time periods. First of all, let's start off with the 2000 time period over here, 2001, 2002, 2003. You can see this clear double bottom, okay? Right around the price that we're trading at currently on natural gas. So not only is it a huge support level currently, but it was a massive support level in the dot-com bubble. And one thing I'm noticing here is natural gas had a huge fall, you can see over here, started putting in a basing formation, a double bottom, and basically when it put in the second double bottom over here, natural gas proceeded to rally all the way to the highs about 100% just to make things easy. Okay, 100% off the lows. Look what transpired from the low in natural gas here, roughly right around, this pivot over here. The S&P proceeded to fall roughly, let me just tighten up this chart, 32%. So go figure, natural gas in a stock market crash, in one of the worst final crashes in the S&P 500 in the dot-com bubble, the S&P was crashing. What was nat gas doing? It was rallying. That is a big divergence. And I think we could be, in the near term, seeing something very similar of that nature. And notice this 32% crash on the S&P 500. That's the exact amount that the DBC, let me throw up the DBC now, back in this pane, and I'll minimize this one. That is the exact same amount that the DBC ETF and natural gas have diverged. So if you look, natural gas and DBC, basically if DBC was to close in the divergence of natural gas back to that pre-COVID high, you're talking about a 33% drawdown to that pre-COVID crash high. So it's just so fascinating to me on a technical picture that you have massive correlations, you have basically very similar patterns, potentially a double bottom zone again here for natural gas forming. And what this could be dictating is that the S&P is in for a world of pain, whereas natural gas could likely see a big rally starting to the upside. So I've been doing a lot of cycle work. There's other patterns. That's just the one we're going to stick to right now. I'll touch base on another interesting one that I've worked on, but we'll just keep this video a little bit shorter since it is a long weekend. But lots of interesting price action. A lot of the fear and sentiment around natural gas is extreme. It has gone through the roof, but this is why we just accumulate slowly. We position ourselves to bring our average down to, yes, we're out of the money, but many people are out of the money. I think the only people that aren't out of the money is market makers and those that haven't taken a nat gas trade. But we just accumulate slowly and position ourselves for that technical bounce. I still think if it goes according to other cycles, 100% rally from this area takes us right back to that target that we've had. That $4 target on nat gas, right to this gap fill. A little bit higher actually. And I think that's certainly something that could transpire even if the stock market is crashing. I think natural gas has been through its crash, just like that 2000 scenario. And I think even if the S&P does start to crash and falter, natural gas should start to rally, and it has certainly historical price patterns and support levels to rally. Because you have to remember, in a stock market crash, yes, many people are fleeing and liquidating, but there's always capital that has to stay long. So they rotate out of stocks and asset classes that are overbought and into the oversold ones. And that's what we saw in the 2000 dot-com bubble. People had to stay long. Institutional funds can't just pull out all their money and sit in cash like us retail people, thank God. But they have to go into sectors and asset classes that are going to go down the least. And considering that this is the most oversold commodity in the basket, you have to respect that if there was a stock market crash, funds are likely going to go into the most oversold asset.